Imagine two neighbors in Sydney, just casually chatting over beers, who decide to build something that teenagers actually prefer over credit cards. Sounds like a pipe dream, right? But in 2014, that's exactly what Nick Molnar and Anthony Eisen did. 8 years later, that side project sold for a mind-boggling $29 billion. And here's the kicker, without ever charging a single cent of interest to shoppers. So how on earth did AfterPay pull this off? How did they convince major retailers to foot the bill, inspire millions of millennials and Gen Z to ditch traditional plastic, and ultimately get one of America's biggest fintechs, Block Inc., then Square, to write the largest acquisition check in Australian history? It's a story worth rewinding for. Traditional lenders, bless their hearts, love to drone on about responsible lending. AfterPay, however, didn't just flip the script, they rewrote the entire play. Their core question was simple yet revolutionary. What if the customer never owes us a cent in interest? The model, when you first heard it, sounded almost too good to be true, almost too simple to work. You split a purchase into 4 manageable payments, you get the product now, and you pay every 2 weeks. If you miss a payment, sure, you're hit with a modest late fee, but crucially, never compound interest. Shoppers, particularly a generation wary of debt, absolutely loved the transparency and control. Merchants, on the other hand, saw their average order values climb and their sales figures jump. And investors, well, they fell head over heels for a growth curve that looked less like a gentle incline and more like a hockey stick on Red Bull. Stick around and I'll unpack the ingenious tactics that turned that initial goodwill into a valuation higher than every Australian bank except the top 4. It's a masterclass in market disruption and understanding what consumers really want. Let's set the scene. After the financial chaos of 2008, a whole generation of young consumers looked at credit cards the way you might look at expired milk, with suspicion, distrust, and a definite urge to keep it out of their fridge. In the United States, for instance, credit card ownership among 18 to 29-year-olds plummeted from a robust 67% to a mere 45% in just 5 years. This wasn't just a blip, it was a seismic shift in consumer psychology. Banks, in their infinite wisdom, responded by doing what banks do, tightening credit limits and hiking those already eye-watering APRs. This predictably pushed Gen Y and Z even further away, solidifying their aversion to revolving debt. Meanwhile, retailers were caught in a bind. They still desperately wanted those young, digitally savvy wallets open, but the old ways weren't cutting it. Layaway, a once popular option for big purchases, felt like a relic from the dial-up internet era. Slow, clunky, and frankly, a bit insulting in an age where same-day shipping was becoming the norm. The chasm between "I want it now" and "I absolutely hate debt" was widening into a canyon, and it seemed like no one was bothering to build a bridge across it. This was the gaping market opportunity, a multi-billion-dollar problem just waiting for an elegant solution. Enter Nick Molnar, a then 24-year-old entrepreneur with an eye for opportunity. He was busy selling jewelry on eBay, and what he kept noticing was a frustrating pattern. Buyers were abandoning their carts right at checkout. They wanted the sparkle but balked at the upfront cost. Across the street lived Anthony Eisen, a seasoned investor in his 40s who was growing increasingly frustrated watching his own teenage kids being bombarded with offers for credit cards sporting punitive 29% APRs. It was a familiar story of predatory lending targeting the financially inexperienced. These two, from different generations but united by a common observation, started talking. Over casual beers on a Sydney porch, the seeds of a revolution were sown. They sketched out a consumer-friendly alternative, short, manageable installments, zero interest, and this was the genius part, the merchant would foot the bill. They borrowed the foundational concept of layaway, but then, with a stroke of brilliance, they sped it up to internet time, making it instant and seamless. They called it AfterPay, because, well, spoiler alert, that's exactly what customers do. They pay after they get their goods. Molnar's first-hand experience with cart abandonment and Anthony's frustration with exploitative credit offers converged perfectly, creating a solution born out of real-world pain points. The initial idea, as the research context notes, even considered 2 payments, but they quickly landed on the now iconic 4-installment model. This wasn't just a business idea, it was a generational response to a broken system. The date was October 2015. The location? Surfer's Paradise, a vibrant coastal town in Australia. The pioneer was a fashion label named Princess Polly. They were the very first retailer to integrate AfterPay into their checkout process. The results were almost instantaneous and jaw-dropping. In that first week alone, 1,200 shoppers used AfterPay, and perhaps even more impressively, the average order value for Princess Polly jumped by a staggering 20%. Think about that for a second. A simple payment option, and suddenly customers are buying more? Within just 3 months, word had spread like wildfire, and 30 Australian brands had signed on. But this wasn't just about traditional marketing. AfterPay's growth wasn't rocket science, it was social science. They ingeniously encouraged their early adopters to spam retailers, in a good way of course, with comments and messages saying, "We want AfterPay." Stores, seeing this undeniable customer demand and the tangible sales increases, quickly caved. And once they signed up, they couldn't help but brag about their bigger basket sizes and happier customers. It was a classic two-sided marketplace, but with a crucial difference. Both sides, shoppers and merchants, were practically begging to join. This organic, grassroots adoption created an incredible flywheel effect, proving that when you solve a real problem, people become your best advertisers. Let's pull back the curtain and demystify the engine that powers AfterPay. Say you've spotted a $100 pair of sneakers you absolutely need. With AfterPay, that $100 is neatly split into 4 manageable $25 payments. You, the customer, cough up the first $25 right at checkout, securing your new kicks instantly. AfterPay then, almost magically, fronts the remaining $75 to the retailer. They don't wait for you. The merchant gets their money, minus a small merchant fee, typically around 4%. Then, like clockwork, your nominated bank card is automatically pinged for $25 every 2 weeks until the balance is cleared. Now, what if you hit a snag and miss a payment? AfterPay's policy is clear and, crucially, capped. Late fees max out at 25% of the item price or $68, whichever is lower. Here's the critical distinction. They never charge interest on the outstanding balance. This is a monumental departure from traditional credit. What this translates to is a business model that lives or dies on repayment volume, not on the revolving compounding debt that so many consumers fall into. AfterPay is incentivized to ensure you repay your installments, not to keep you in a perpetual cycle of interest payments. It's a subtle but profound difference that fundamentally reshapes the relationship between lender and borrower. For a long time, critics assumed AfterPay's entire party was funded by those pesky late fees. Wrong. Dead wrong. The truth is, roughly 90% of AfterPay's revenue, the vast majority of its income, comes directly from merchants. This often begs the question, why on earth would a retailer willingly give up 4% of their sale? The answer is pure economics. AfterPay isn't just a payment processor, it's a sales generator. Retailers consistently report that when AfterPay is an option, average ticket sizes rise by a significant 20 to 30%, and remarkably, return rates often drop. Think about it. When a pair of jeans costs you $25 today instead of an intimidating $100 up front, shoppers are far more likely to splurge a little more, perhaps adding that matching top or another accessory. AfterPay effectively removes a major psychological barrier to purchase. But there's another huge benefit for merchants. They offload the credit risk entirely to AfterPay. No more chasing down bad debts or dealing with chargebacks related to installment plans. Essentially, retailers gain an outsourced marketing and collections department that doesn't just manage their customers, but actually pays them, in the form of increased sales and growth. It's a symbiotic relationship where AfterPay drives demand and absorbs risk, and merchants happily pay for that powerful combination. AfterPay's early tagline was a masterclass in clarity and directness. Shop now, pay later, no interest, ever. Clear, punchy, and absolutely no asterisks hidden in microscopic print. This simplicity was mirrored in their user experience. Signing up was a breeze, requiring only an email, phone number, and a debit card. Approval took mere seconds thanks to their proprietary risk technology. This wasn't a deep dive into your FICO score, it was a quick, intelligent assessment that allowed even thin-file customers, those without extensive credit histories, to finally get included in the purchasing power enjoyed by others. Once inside the app, AfterPay subtly gamifies responsible behavior. On-time payments aren't just expected, they're rewarded. Consistently paying on time unlocks higher spending limits, creating a positive feedback loop. This psychological trick, a dopamine hit for good financial habits, keeps users hooked and engaged, arguably more effectively than scrolling through endless latte art on Instagram. It's a brilliant blend of accessibility, instant gratification, and responsible incentives, all wrapped up in a user-friendly package.
After conquering Australia, AfterPay set its sights on global domination, or at least significant international expansion. The playbook was simple but effective, a grassroots strategy that replicated their initial success. First stop, New Zealand in 2017, then the big leap across the Pacific to the United States in 2018. The following year, 2019, saw them land in the United Kingdom, where they wisely rebranded as ClearPay to resonate better with their tea-drinking cousins. In each new market, they meticulously replicated their winning formula, partnering with local influencers who understood the cultural nuances, riding the wave of social commerce, and letting customers do what they did best: scream for AfterPay integration at their favorite stores. The US market, in particular, proved fertile ground. Major brands like Urban Outfitters, Revolve, and Foot Locker signed on within months of AfterPay's launch. The results were staggering. Stateside active users exploded from 1 million in late 2018 to a whopping 8 million by mid-2020. This rapid uptake wasn't just a testament to their strategy, it was clear evidence that the fear of debt is a universal human experience, but so too is the irresistible lure of instant fashion and flexible payments. AfterPay quickly became the fastest-growing public company in Australia's history, demonstrating its powerful appeal to a new generation of shoppers. Then came 2020, and with it a global pandemic that nobody saw coming. Lockdowns became the new normal, which, for many, translated into a potent cocktail of boredom, stimulus checks, and an insatiable desire to fill up online shopping carts. This unprecedented shift in consumer behavior acted like pure jet fuel for AfterPay. Their US underlying sales tripled in 2020 alone, and where sales go, share prices often follow, sometimes with a vengeance. AfterPay's stock, which was trading around $8.90 in March 2020, soared to an astonishing $160 by February 2021. Suddenly, a company that hadn't yet posted a full-year profit was worth more than Qantas, Vodafone UK, and several regional banks combined. It was a dizzying ascent. The lesson here is profound. When consumer behavior shifts dramatically and macro events align perfectly with a disruptive business model, traditional valuation metrics can look like absolute typos. AfterPay was in the right place, with the right product, at precisely the right time, riding a wave of digital adoption and financial prudence that swept the globe. Of course, where there's explosive hype, there's usually a lot of heat. The meteoric rise of BNPL didn't go unnoticed by watchful eyes. Regulators, particularly in the UK, began eyeing the sector with increasing scrutiny, calling for mandatory affordability checks to ensure consumers weren't biting off more than they could chew. In the US, consumer watchdogs like the CFPB started raising concerns about debt stacking, the worrying trend of consumers using multiple BNPL apps simultaneously, potentially accumulating unmanageable debt across various platforms. And then came the cavalry of competitors. The market, seeing AfterPay's success, became flooded with rivals, established fintechs like Klarna and Affirm, payment giants like PayPal with its Pay in 4 offering, and even tech behemoths like Apple with Apple Pay Later. Even old-school banks, initially dismissive, scrambled to launch their own copycat installment plans. AfterPay, recognizing the evolving landscape, responded proactively. They introduced their Pulse loyalty program, rewarding on-time payments with perks and higher spending limits. They also published clear and comprehensive hardship policies, demonstrating a commitment to responsible lending even without charging interest. In this increasingly crowded and regulated space, retention of their loyal customer base became just as crucial as initial acquisition. By 2021, AfterPay was a force to be reckoned with, but a bigger player was watching. Square, Jack Dorsey's payment processing and fintech powerhouse, now Block Inc., had its own formidable asset, Cash App, boasting 70 million annual consumers. AfterPay, by comparison, had a respectable but smaller 16 million. The strategic vision was clear. Merge the two, and you'd own both sides of the checkout experience, the merchant-facing payments and the consumer-facing wallet. This wasn't just an acquisition, it was a grand unification. The story goes that Jack Dorsey himself texted Anthony Eisen on a Sunday in 2021, setting the wheels in motion. By August, the deal was public, a staggering $29 billion acquisition in block stock, making it the richest buyout an Australian company had ever seen. AfterPay investors received 0.375 block shares for every AfterPay share they held. Overnight, Square was transformed into a BNPL powerhouse, instantly gaining market share and expertise without having to write a single line of code or build a new product from scratch. It was a testament to AfterPay's value and Block's ambition to create a seamless end-to-end financial ecosystem. AfterPay didn't disappear. It became a crucial integrated component within the vast Block Inc. ecosystem. It now lives comfortably inside Cash App for consumers and is seamlessly integrated into Square seller dashboards for merchants. What does this mean in practice? Merchants can now simply tap a button to offer AfterPay installments to their customers, leveraging a payment option that's already proven to boost sales. So what's next for AfterPay and the BNPL model? The future playbook is already being written with intriguing possibilities. We've seen tests of subscription BNPL, where AfterPay experimented with allowing customers to pay for things like gym memberships in 4 convenient bites. Imagine applying that to streaming services, software subscriptions, or even utility bills. There's also the potential for B2B installments, with pilots already underway with Shopify merchants who need flexible payment options for buying inventory. And given Block's deep love for Bitcoin, don't rule out the possibility of 4 payments in Satoshis someday. Whatever innovation comes next, the core mission, the underlying philosophy, remains steadfast: to let humans transact without the trauma, the fear, and the punitive nature of traditional credit. It's about empowering consumers with choice and flexibility. AfterPay didn't win by inventing the concept of installments. People have been paying things off over time for centuries. No, AfterPay won by brilliantly reading the room. They understood a generation spooked by the financial crisis of 2008, a generation armed with smartphones and utterly addicted to convenience. These consumers wanted shopping without the shackles of high-interest debt. By ingeniously shifting the risk and reward onto merchants, AfterPay carved out a $29 billion middle ground, a perfect sweet spot between the rigidity of cash and the often punitive nature of traditional credit. Along the way, it completely rewrote lending norms, sent shivers down the spines of established banks, and became a powerful case study in impeccable timing, brilliant branding, and the sheer power of a simple, compelling promise: no interest, ever. Whether Block can successfully keep that rebellious spirit alive under the increasing pressures of rising interest rates and mounting red tape remains the next captivating episode in this fintech saga. But one thing is absolutely certain: the plastic in your wallet finally has real, meaningful competition. And this new contender doesn't charge compound interest, it charges imagination.